and Happy New Year to all the viewers and listeners of this edition of Fixed Income Market with Sundaram Mutual Fund. As expected, Federal Reserve has raised the rates by a smaller quantum of 50 basis point, although the commentary has been hawkish, as well as the terminal Fed funds rate is touted to be higher than 5%. Despite the tough talk in raising rates, the markets believe that Federal Reserve will have to pivot sooner than later, as both the 10-year yields and dollar index have moved down, indicating that the market does not believe the Federal Reserve on rates. In general, the emerging market central bankers have to largely follow the Federal Reserve, as any large differential in rates will play through the currency markets. In our opinion, flows in emerging market bonds is likely to stay muted if rates in DMs remain higher for longer. On the inflation front, the key monitorable will be the energy prices and grain prices, as both of them are responsible for spike in inflation in the developed markets. As of now, higher winter temperatures in Europe and normalization of grain supplies have resulted in prices cooling off. Also, as the higher base prices have been set up last year, the year-on-year inflation is likely to head lower, maybe not toward the 2% target, but much lower than the last year high. India inflation is also likely to show a downtrend as the vegetable prices decline on fresh arrivals and other food prices remain moderate. Having said that, India needs to closely monitor both its current account and fiscal account to prevent any spillover on the prices of goods and services. In such a backdrop, this new year, the hope from investors is running high like the rate hikes by the central banks. Not completely far-fetched, as the accrual rates on fixed income portfolios across duration curve has become attractive. Consider the portfolio yield on liquid fund in the vicinity of 6.5 now from 3.5% a year back, almost double. This offers inherent protection to the fixed income investor from volatility in higher duration buckets. On the face of it, as the curve has become flatter, incentive to earn portfolio yield going up on the curve looks futile. But if the prognosis is of rates moving south during 2023, adding duration helps the investor earn the multiplier effect. As a simple example, in a 1 year Mackellar duration portfolio with 7% yield and a 3 year Mackellar duration portfolio with 7% yield, income over 1 year with half a percent down move in yields will be 7% for 1 year portfolio, 1 year Mackellar duration, and 8% in 3 year Mackellar duration portfolio after 1 year. With the economy-wide rates higher, the hurdle rate for other asset classes also becomes higher, an outcome of tighter liquidity conditions as the central bankers in developed markets both raise rates and normalize excess liquidity to counter inflationary impulses built up in the economy. Excess liquidity near zero rates has resulted in very low risk premiums demanded. All this now is likely to change, and some of that is already evident as well. The flatness in the yield curve is still there, and we recommend that investors can look to deploy monies in mid-duration active strategies, as we may see a decline in yields on account of inflation moving down toward the MPC target of 4%, but should be more statistical in nature, and any negative outcome on monsoon or any other event which we can't envisage at this point in time, like any other climatic event or geopolitical tension, can result in spike in prices. Conservative investors are best advised to put monies in roll down maturity product where the inherent duration risk reduces with each passing day. Thanks for joining us in this episode. Looking forward to see you in the next episode.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.